Happy Tuesday, everyone. We're here with Buy, Sell, Rent with TNT, and we have our special guest speaker today, Mr. Bob Fenester with Green Tree Mortgage. Bob, say hello.
Hello, everyone.
And we have my partner, Miss Tiffany Radamicki, who is coming on. She is still on mute, but we would like to welcome everybody for coming on today. Today, our topic is credit myth busters, overcoming credit misconceptions on the way to loan approval. So we decided, everyone knows that this month, or if you don't know, this month is homeownership month. And so we know that as we're coming out and still going through, but starting to come out more during this COVID time, that a lot of things have changed in light of lending practices. But Bob will also debunk, as we say, some of the myths that we have when we are on the road or deciding that we want to, let's say, purchase a house or get any type of loan. So Bob, Tiffany, do you have anything to say before we begin with Bob?
Welcome everybody. Hello, hello, hello. Trying to get my camera correct, and I'm good now. Am I still on mute?
No, you're not on mute. You're alive. We hear you.
Okay. Well, I'm looking forward to the presentation. Are we myths?
You're breaking up, Tiff. Yep, you're breaking up. Yeah, we hear you, but it was breaking up. So Bob, if you'd like to start and give a little introduction about yourself and what we're going to cover as we start today, and you can also start your presentation if you like.
Did you want to do your little invocation?
Oh, I'm sorry. Yes, thank you, Bob. I do a little. Yes, so we'll bow our heads. Dear Heavenly Father, we'd like to come to you right now, thanking you for allowing us to wake up to see another day. We thank you for your grace. We thank you for your mercy, Lord. We ask a covering over each and every one that's represented, every family that's represented here today. We thank you for the opportunity. We thank you for the willing spirit to continue to feed into our communities all that we can so that we can move forward in the right way. I thank Bob for his professionalism and just his knowledge and willingness to come on and share all that he knows. In Jesus' name we pray, amen.
Thanks, Tammy.
Everyone for joining us. Thanks, Tiffany. The purpose of this class is really to help shed some light on what is something fairly mysterious, and that's credit reports and credit scoring. The premise behind the class is this. In the years that I've been a mortgage loan officer, I have listened to a lot of people tell me what they believe to be true about their credit score and about credit reports. And unfortunately, a lot of those things that people believe to be true, in fact, aren't. And the actions that they ultimately take end up hurting their credit score, hurting their chances for approval on a mortgage. And the whole point of this class, Credit Mythbusters, is to dispel those misconceptions, to bust those myths, and to really help people raise their credit scores, be sure that they get approved for a loan, and get approved at the best possible interest rate. Remember, the higher that credit score, the lower the interest rate. And that's something that everyone should be shooting for. So let's start with this. Let's start with the notion of, why do credit myths exist? And it all starts with this. The credit scoring model is a huge mathematical formula that takes all the data that's on your credit report, runs it through this algorithm, calculates probabilities, calculates mathematics, and produces a number. And that number tells a lender your probability of default on a loan. It all started, really the credit score as we understand it today started in 1989. It came from the Fair Isaac Company, and they produced this mathematical formula which drew data from a credit report and created these numbers. They showed them to lenders, and lenders quickly realized that those statistics that they were giving them very accurately predicted default rates on not only mortgages, but all types of loans. Fast forward 6 years later, Fannie Mae, seeing the performance of these credit scores, made it mandatory that a credit score be derived with every loan application. If you want to follow the rules of Fannie Mae, and for those of you that may not know, Fannie Mae is the quasi-governmental agency that exists to promote housing in the United States and to promote mortgages. They back the mortgages. 90% of the mortgages that lenders write are backed by Fannie Mae and follow Fannie Mae guidelines. And Fannie Mae mandated in 1995 that every mortgage file have with it a credit score and set guidelines for just, how low those credit scores can be before a loan, is denied, how high it needs to be for the loan to be acceptable. So keep in mind, the Fair Isaac company that produces the scoring model is a private company. When Fannie Mae made this proclamation, this rule change, you can just imagine the windfall, how much money that company made. So the reason credit myths exist is that no one, I don't think any of you can, no one can recite that formula. Nobody knows the credit scoring formula. It's, even if you did, it would probably take you 3 hours to write it all down. It's an incredibly complex mathematical formula, an algorithm, if you will, and it's a secret. It's the Fair Isaac company's secret. They do not want to share this mathematical formula with you. They're not going to post it online. They're not going to give you the formula. If they did, then people would score their own credit. And the Fair Isaac company, who charges lenders, by the way, for those credit scores, would lose their source of revenue. So the credit scoring model is a trade secret. I always compare it to the Coca-Cola formula, okay? No one knows what the Coca-Cola formula is, except for a couple of executives in Atlanta. And, I think people that join the company have to sign a piece of paper where they won't divulge it. Spoiler alert, it's sugar and brown stuff and bubbles. But, it's not terribly important for us to know the Coca-Cola formula. But it is important for us to know the credit scoring formula, and we don't. And because that formula was kept secret and is still kept secret, people take their gaps in knowledge and they fill in. They fill in the gaps. They fill in with their intuition. They fill in with what they think is cause and effect. You check your credit score on Tuesday and it's a 660. And on Wednesday, you put on your lucky socks because you're going to watch the 76ers play. I'm obviously talking about before COVID-19. And then you check your credit score on Thursday and you see your credit score has gone up to 680. You're like, oh, I know what it was. It was my lucky socks. Wear lucky socks to raise your credit score. It's that sort of false cause and effect that people think that they see that causes them to promote myths about credit. It seems to make sense, but it's not necessarily accurate. And the Fair Isaac company isn't necessarily telling you. Now, the Fair Isaac company has come under pressure, and they've been pretty open about this. They've come under pressure. Consumer advocates, government agencies look at the importance of credit scores, and they say to the Fair Isaac company, you have to give us some hints. You need to let us know how this scoring model works because this is just too important. People do need to get approved for mortgages and car loans and credit cards. And people do need to be able to take positive actions to improve their scores and improve their rates on those loans. And the Fair Isaac company has, done that. They have gone about releasing some of the information. So let's just take a look here. I'm going to try to load up my PowerPoint.
Okay.
Is that showing up on the screen, the PowerPoint? Screen
Not
share.
yet.
Here we
It
go.
should. Yes, screen share. Yep.
Okay, screen share. Can everybody see me?
Yes, we can.
All right, so
So this is popping up, so if you would just minimize it.
minimize that.
Yep. And just move it out of the way. We can put it down here or something.
And now they can see me fine. Okay. All right. So anyway, welcome to the class. So basically, here's how credit myths arose, and here's how they're debunked. So there have been calls for transparency, and the Fair Isaac Company has responded. And let me just try to show you here. I'll show you this. This is actually a publication from the Fair Isaac Company called Understanding Your FICO Scores. And yes, I know it's about FICO score, so just imagine how boring that is. But it's actually surprisingly readable. So I really do recommend that you look for this. You can find it at myfico.com. It is 30 pages long. There are lots of pictures, so it's the reading's not too heavy, and it really is a very informative publication to help you get a handle on understanding your credit score and dispelling some of the myths surrounding credit. Okay, so let's see pardon me, now I can't see. I need to move this
You want the presenter one?
and pop back to that. Okay, so what I'd like to do now is just sort of get into some of what I call the greatest hits of credit myths. And let's just go through them. And I want to start here. And it's this. The question is, or the premise is, I can check my credit score online. So for those of you on Facebook or on the Zoom, if you could just throw in your answer, what do you think? I can check my credit score online. And yeah, I know it seems like an obvious question. You've probably got Credit Karma, Credit Sesame, maybe an app on your phone. What kind of answers are we getting?
True.
True. Okay. So, so by the way, I'd like to introduce my daughter is sitting here. She's my virtual audience. She's monitoring your answers on Facebook Live. And so most people think that they can check their credit score online. And yes, you can get a credit score. If you go online, if you use Credit Karma, if you use Credit Sesame, you're getting a credit score. But here's what you're getting. You're not getting the credit score that I get. So the larger question is, what is a credit score really? A credit score it's not just a number. A credit score is actually a statistic. It's a statistic that tells a lender what your probability of default is on a particular loan. Now, the point to remember is that probability varies. Is your probability of default the same on a mortgage as it is on a car loan? Is your probability of default the same on a car loan as it is on a credit card? The answer to those questions is no. And there are different credit scoring models that address those different types of loans. So you've got a credit score for your car. If you call up a car dealer, they'll give you a credit score. Here's your credit score. If you immediately hung up the phone and called a mortgage lender, they would give you a different score. The reason is the credit scoring model for car loans measures your default risk on a car loan, and the credit scoring model for a mortgage measures your default risk on a mortgage. They're two different risks, so you have two different scores. Here's the question. When I check my credit score online, what am I checking? An even wider question, a more esoteric question is, if I'm not applying for a mortgage, if I'm not applying for a loan, do I even have a score? Well, the thing is that when you check your credit score online, you're not getting a real credit score. You're not getting a credit score that is telling a lender a default risk on a loan that you're applying for. What you're getting is what's known as a consumer score or an educational score. It's not a score that a lender is using to make a decision about lending you money, be it a credit card, student loan, auto loan, or mortgage, okay? You're getting effectively a conglomeration of all those things, all right? It's a reasonable facsimile of what your mortgage credit score might be, but it's not precisely what I see. And by the way, those consumer credit scores tend to run a little higher than the mortgage credit score. Here's why. The auto credit scoring model and the credit card scoring model have scales that go up to 900. The mortgage scoring model scale only goes to 850. So if you're going to conglomerate them, if you're going to average them, if you will, the mortgage input to that average is the low score. So your mortgage score is always lower. So if you're checking it online and then you call me, yes, I'm Mr. Disappointment, I'm going to get a number that's a little bit lower. I want to take a question.
What happens when my car insurance chooses to use my Experian credit score, which is lower than my actual credit score, and it raises my insurance?
Okay, so the question is, what happens if my auto insurer uses my Experian credit score, which is lower than my other scores? I guess the answer to that question is maybe shop with another auto insurer who might be using one of the other scoring models. I want to sort of speak to another point with that, and it's this. Where your credit score actually comes from. The credit score doesn't actually come from the 3 credit bureaus, the 3 credit reporting agencies. And most of us know who those are. It's TransUnion, Experian, and Equifax. They just produce the data. They gather the data, the payment history, the balances, and so forth. And that data gets fed through the Fair Isaac credit scoring model to produce your score. Now, what you may not know is that not every creditor, not every bank, credit card company, credit union, auto lender, etc., reports to all 3 bureaus. So the credit bureaus do have slightly different information from each other. That's why each credit bureau, that's one of the reasons why each credit bureau will produce a slightly different credit score for you. Okay, so if you happen to have among the 3 bureaus, your low score is coming from Experian because they're picking something up that the other bureaus aren't. And unluckily, the insurer or lender that you're standing before is using that credit score, then yeah, you're not going to look as good to them. And you may want to ask them to use someone else or possibly talk to another insurer that uses a different bureau to run your credit score. Okay, so getting back to the credit scores that you check online, they're consumer credit scores. They're not the credit scores that a lender uses, which sort of leads me to another question, and that's this. How many credit scores do you have? I don't know how many of you remember this, but a while back there was a TV ad, and this TV ad actually depicts how my daughter's dating life is going to be. And it was like this. A couple was getting together at a table in a restaurant, and they both sit down and they're clearly on a date, and hovering behind each of their heads is a number. It's their credit score. And yes, you should check your potential son-in-law's credit score or daughter-in-law's credit score because when you marry someone, you marry that credit.
Yes, you
okay.
do.
And the reality is that what was inaccurate about that particular ad is this. Take a look at this. This is a list, and this isn't the complete list, by the way, of all the different credit scores that you have. The reality is that you don't just have one credit score hovering behind your head, you've got a whole swarm of them. And let's just take a look at some of these. So if you take a look at your screen, you can see these are the credit scoring models, the versions that are used in auto lending. The FICO Auto Score 8, FICO Auto Score 2, Auto Score 5, Auto Score 4. And what you see is here's the credit bureau, the credit reporting agency, and this is the credit scoring model that their data gets pushed through to produce a credit score. So when you call an auto lender, they're probably using these scores right here. If you hang up the phone and you call a credit card company, they are using these credit scoring models, bank card scores, okay? It's going to produce a different number because it's measuring a different risk, okay? If you look down here, here are the mortgage lending scores. All right, so what does all this mean? Basically, it means you don't know precisely what your credit score is. You actually have to make a loan application to get the true score, your credit score, your probability of default for that particular type of loan. Confusing. Now, if you do want to see all of these credit scores, you can. It's not free. The Fair Isaac Company does have a subscription service. I believe it's about $15 a month. And on that service, you can see all of these credit scores. It's a dizzying amount of numbers, but you can keep track of where you stand everywhere. Now, let's just talk for a moment about Credit Karma. It's pretty widely used. I have it on my own phone. I track it. Credit Karma produces a credit score, but it's not a credit score that comes from the Fair Isaac Company. Remember I said the Fair Isaac Company got this mandate, this windfall from Fannie Mae back in 1995 when Fannie Mae said every loan application that's going to be approved by Fannie Mae has to have with it a FICO mortgage credit score. Well, that was a goose that's laying golden eggs. So a company came along, it's called Vantage, and they want a piece of that action. So they came up with their own credit scoring model. Now, that particular credit scoring model is not being used in mortgage lending. It is being used, from what I understand, in some other forms of lending, but it's the Vantage credit scoring model that's actually producing the credit score that you see on Credit Karma. So now back to the question of how many credit scores do you have? Take all of this and multiply it by Vantage. And we're probably up to about 30 credit scores for any one individual. So once again, a dizzying number. I want to take a question.
Are the scores added up? And if so, like how high could the scores go?
Okay. The credit scores, the question is, are the scores added up? The scores are not added. Typically what we do is you may apply for a credit card or you may apply for a car loan. And that particular lender, because they're being charged to run these scores, to access these scores, they may only take an Equifax credit report and run it through the FICO credit scoring model. So, if your Experian is higher or your TransUnion is higher, you may not be getting the full benefit of a higher credit score. In mortgage lending, and from what I understand in most automobile lending, we pull all three credit scores. So down here, these versions used in mortgage lending, we're going to pull all three. And then what we do is we go by the middle of the three. So if you're 710, 705, and 717, the middle of those three scores is 710. We're going to use 710 as a basis for making our loan decision and as a basis for setting the interest rate on your loan. We go by the middle of the three. I have heard once upon a time before the financial crisis, there were some lenders that would average them, feeling that somehow created an advantage for the buyer. It really doesn't. Your middle score versus your average, flip a coin as to which one's actually better for any one individual. But for the most part, we're going to take the middle score in mortgage lending. Okay, all right, so that's how many credit scores you have. So let's get back to the notion of, can I check my own credit score online? And what is really the value of all this information? Credit Sesame, I have the Experian app on my phone. I've got Credit Sesame, I've got Credit Karma. Every time I go to pay my credit card bill, I see my credit score on the way in online. What's the value of all this information? Well, first of all, the thing to remember is that those are not true credit scores. They are not the credit scores that a lender is going to see. So that doesn't mean they're without value. And the way I usually explain it to people is this. The credit score that you see on Credit Karma is almond milk. Real milk comes from a cow. I'm the cow. I can produce the real credit score for the type of loan you're applying for. Credit Karma, while it's not real milk, it's just almond milk, you can still use it to make a latte. And here's what I mean by that. Credit Karma, while it's not official, is a pretty good guide of the movement of your credit score. In other words, If I run your credit score and I tell you, hey, that score is 577, you need to raise it you should raise it by 50 points to get a decent rate to get approved and get a decent rate on a mortgage. So go to Credit Karma, wherever that score is today. It might be 597, might be 20 points higher than what I have. Make Credit Karma move 50 points, and the official score will likely move about 50 points. So it is a good guide for managing and monitoring the trajectory, the movement of your credit score, especially if you're trying to improve it. Now, I do want to say this, when it comes to things like Credit Karma, where it becomes dangerous is if you're in one of these marginal places. If you check Credit Karma and you see an 810, you know you're good. Even if I get something 20 points lower, I get a 790, you're still A+. To get a mortgage today, prior to COVID-19, you needed a 580 credit score. Now, with COVID-19 going on, you need a minimum 640 credit score. Unless you have a 20% down payment, then you may get away with a 620 credit score. So the value of something like Credit Karma and the danger of something like Credit Karma is if you check it and you see a 640 and think that you're good, when someone runs your official score, they may pull a 620 or a 610, and you're not able to get approved for a mortgage. So it can lull you into a false sense of security, okay? The other thing, and this goes for a lot of the advice we're going to give you here today, is that this is really the advice for people in the margins. You want to be at least 640. If you get to 680, that opens a lot of options for you. If you get your credit score to 740, that gets you the best available rate on the rate sheet. So if you're somewhere below 740, then this advice really pertains to you, okay? You need to be careful about what you do. If your credit score is 760, 780, 790 on Credit Karma, even though your official score is lower, you're going to be fine. Okay, so remember that a lot of what we're going to talk about here is really geared towards people on the margins, to get yourself approved, to not take a step, that gets your loan declined. Okay, so let's just take a look at this. Some of you may have seen ads for Experian Boost. And here's what Experian Boost is. Experian Boost, it says only Experian can raise your FICO score instantly. The question is, can it really? Well, yes, it can. Experian Boost does this. Let's go back here. Experian Boost operates on this FICO score 8. I know it says most widely used version, but it is not used at all by lenders. Okay, it's not the auto score 8, it's the FICO score 8. It's a consumer credit score. So what this consumer credit score has done is it has incorporated a feature that allows you to add your cell phone bill history, your electric bill history, your cable bill history, your rental history. And what you do with Experian Boost is you go to Experian Boost and you give it some information, some banking information, so that Experian Boost can basically read payments in your bank statement and see you paying your electric bill, and it can see you paying your cable bill. And it then adds that as credit history on your credit score report, which in turn boosts your score. Here's the catch. The catch is this. With Experian Boost, you direct it to which bills you want it to look at. So if you're paying your cell phone bill on time, but you're not paying your cable bill on time, or maybe you've even defaulted on your cable bill and had it shut off, you can still boost your credit score by showing them just the cell phone bill, which you know is paid on time. It gives you as a consumer the ability to manipulate your credit score. Unlike a credit report, where creditors report to the bureau and they report the good, the bad, and the ugly, with Experian Boost, you get to pick and choose, and you only report what's good. So how do lenders feel about that? Well, they don't like it. And as a result, the ability to manipulate a credit score with Experian Boost and services like it using FICO Model 8 means that lenders don't use it as a basis for making a loan decision. And it as much as tells you right here, the credit score calculated on FICO Model 8 is calculated on FICO Model 8. Your lender or insurer may use a different FICO score. And by may, they mean will. The lender will use a different credit score, not this one. FICO score 8 or another type of score altogether. And once again, we're definitely going to use something different. The credit scoring model that we use will not be affected by this. So again, what's the value of Experian Boost? Well, there's really no value to it to a consumer. It's really just a matter of adding chocolate syrup to your almond milk. It does not help you in any way with getting approved for a loan. Okay, so let's look at this one for a moment. True or false? Close accounts to improve your credit score. I'll give you a moment. What's coming in there, Alina? What are the comments?
Wait, close accounts to improve your score. Sure.
Okay, so we're getting some trues and some falses. So here's essentially how this works. This is actually a myth. It does not improve your credit score by closing accounts. And I'm talking mostly about credit card accounts, okay? So what happens with the credit scoring model is the credit scoring model measures something called credit utilization. Here's an example. If I have 2 credit cards and each of those credit cards has a $5,000 credit limit, and I have one of them has a 0 balance and the other has a $2,500 balance. Great. So right now I have a total of $10,000 in available credit and I'm using 25% of it, $2,500. I look at my credit report and I look at my financial situation and I realize that card with the 0 balance, I don't use it. And they charge me an annual fee. So I'm going to close it before that annual fee gets charged. Now what happens is the credit scoring model looks at my report and it sees that I have $5,000 in available credit now, and I'm using $2,500. So my credit utilization ratio went from 25% to 50%. Makes it look like I'm overusing my cards. It makes it appear as though if I encounter a financial hardship and I need to use that card, if I lose my job or I get sick and can't work, I don't have as much room to run on that credit card to buy my groceries, to pay my rent, to meet my daily living obligations, okay? So when that credit utilization ratio goes up, my credit score goes down. How much will it go down? Well, a lot depends on what else is on your credit. And again, this is a tip if your credit score is not over 740. If you're on Credit Karma and you're pulling 790, 800, feel free to close that account that has, the annual fee that you don't want to pay anymore, okay? If you're marginal, if you're a 680, if you're a 670, then maybe you leave that open. Maybe you bite the bullet one more year and pay that annual fee. And then once your mortgage is approved, then you can close the account, okay? So that's credit utilization. To improve your credit score, pay off collection accounts. What do we think, Alina? What kind of answers are coming in? If you pay off a collection account, it improves your credit score. True or false?
We are getting a false maybe and some truth.
Okay, all right. So this, in fact, is a myth. Again, when we talked about paying off credit cards, I want to get back to this notion. I want to give you this notion that what is wise financial advice may not necessarily be wise credit advice. And by that, I mean, hey, I closed the credit card because they're charging me an annual fee and I wasn't using it. That's smart financial advice. but it actually lowered my credit score. So good financial advice is not necessarily good credit advice. And that's an important distinction to make. People think the two are the same. They are not. Here's what happens when it comes to collection accounts. The credit scoring model dings you because you let the account go into collections. Now, because you're about to apply for a mortgage and you go ahead and pay off your collection accounts, that doesn't get you any favors from the credit scoring model. Okay? What happens is when you pay the collection account off, it remains on your credit report as a paid collection. The collection account pulled your credit score down. Paying it off did not make it go back up. That's important for folks to remember. Now, consider this for a moment. Let me ask you the question. Do you think you have to pay collection accounts off to approve for your mortgage? Well, the truth is you don't. Here are the rules. If you're applying for an FHA mortgage and you have non-medical collections that total $2,000 or more, then you have to pay them off. But if your non-medical collections are less than $2,000, you don't have to pay them off. What's more, they completely ignore medical collections. I've closed loans for people that have had $6,000, $7,000 in medical collections open. The FHA does not make you pay off medical collections ever in order to approve for a loan. With conventional loans, Fannie Mae rules, Freddie Mac rules, VA rules, they basically have complete faith in the credit scoring model. So even though the collection accounts are there, as long as your credit score is good enough for the loan program that you're applying for, you won't have to pay them off. Now, there are two important exceptions to this. Important exception number one is student loans. If a student loan goes into collections, then it can become a federal debt. And in the case of a foreclosure, they can effectively butt the line. So that student loan in a foreclosure might get paid before the mortgage. That's something that obviously lenders don't like so much. So student loans do need to be paid. If they're in collections, they need to be either paid off or brought current, meaning you need to get back on a payment plan with that student loan lender before you can be approved for your mortgage. The other important area where you might have to pay the collection accounts off is if you apply for a first-time homebuyer plan. Those plans are generally administered by state and county bodies, and they make their own rules, and oftentimes those rules do call for you to have to pay off collection accounts, yes, including medical collections, in order to get some first-time homebuyer help. But your basic conventional loan, FHA loan, VA loan, you do not have to pay collection accounts in order to get approved for the loan. Okay, so let's talk about medical collections for a moment. There's a new truth about medical collections, and it's this. Consider a medical collection for a moment. A medical collection is strictly involuntary. You did not ask to get sick. You did not ask to go to the emergency room. And you certainly did not ask for your health insurance company to deny the claim when you submitted the bill. Okay? So medical collections are involuntary and oftentimes the result of legitimate disputes between an insurance carrier and a consumer. So people looked at that and said, hey, that is not so fair. And one of those people was the New York Attorney General. The New York Attorney General looked at it and said, hey, medical collections are involuntary. They're often the result of something, a legitimate oversight or a legitimate dispute over insurance coverage. So they sued the credit reporting agencies and said this, we don't think this is fair. When someone pays off a medical collection or when their insurance company pays it off on their behalf, we think that collection account should be removed from the report entirely. Remember, when you pay a collection account off, it remains on your credit report, okay? And it continues to hold your credit score down. What this is saying is that now, when you pay it off, it comes off the credit report entirely. Now, they sued the credit reporting agencies. It never went to court. The credit reporting agencies quickly agreed with them, and they made this agreement. The agreement is between the credit reporting agencies and the New York Attorney General. So it's law in the state of New York. However, the credit reporting agencies have agreed to honor this agreement in all 50 states. What does that mean for you? Well, it means that if there are medical collections on your credit report, you have a fairly easy vehicle, simply paying them off, to raise your credit score. And those results can be significant, 40, 50, 60 points in credit score lift. It does take a little work, however. It is the law in New York. Outside of New York, it does not happen automatically. So if you want to pay off a collection account, you do need to make a phone call. You probably need to get a manager or possibly the legal department on the line. If you're going to start talking about the settlement between the credit reporting agencies and the New York Attorney General, to the first person that answers the phone, they will not know what you're talking about. So you're going to have to elevate it. Something else, you may need to employ an attorney. You may need to employ a credit repair person to help you. This is not easy to navigate, but if you spend a little time, spend a little money, you will get those medical collections removed once you've paid them off, and you'll see a nice lift in your credit score. Okay, so let's just talk about this for a moment. To raise your credit score, settle with the collection agency. And by settle, I mean you have a collection account. I'll give you the example. I not long ago spoke with a woman who I ran her credit, and on her credit report was a $4,000 collection account. That collection account was the result of she had co-signed a car loan for her son. Her son did not tell her that he stopped paying. The car got repossessed. The lender sold it, and there was a $4,000 deficiency. Never told mom. Mom finds out when I run her credit. Now, it's over $2,000. She had a credit score in a place where I needed to do an FHA loan, so I couldn't approve it with the $4,000 collection account there. So I let her know she needed to pay it. Now, when you call a collection agency and you have an account that large, they will often try to make a deal with you. They will tell you, hey, instead of $4,000, give us $2,000, and we'll call the account settled. Here's the issue. As soon as it's called settled and they report it as settled, that lowers your credit score. That creditor reports settled. It says the creditor took a loss. They didn't get all the money that they were owed. And as a result, the credit scoring model sees you as a higher risk, and your score goes down as much as 40 points by taking that settlement. Now, you have to be very careful with this. I want to show you what happened with the woman that I was telling you about. I told her, you need to call these folks, and if they offer you a settlement, you have to tell them that I will, pay you this lower amount, but only on condition that you send me a letter that says that the account will then be paid in full. Paid in full are the key words. So she called, they had some back and forth, they agreed, and they sent her this letter where it says, upon the clearance of your payment, your account, I don't know if you can see it there, my cursor's not coming up so well, the account will be settled in full, okay? So she thought that there was no difference between paid in full and settled in full. The fact of the matter is the credit scoring model, the credit report has a code for paid in full and a code for settled. There's no code for settled in full. So when I ran that credit, it showed up as settlement accepted, and her credit score dropped by 40 points. She showed me the letter. I said, look, it says settled. We can try to dispute this. It probably won't fly. We did dispute it, and we lost the dispute. And unfortunately, it took this person over a year to get her credit score back to where it was prior to the settlement. Okay, so we don't want to settle. The rule here is don't settle for less. If you do want to try to settle in exchange for them reporting it as paid in full, My suggestion is that you employ a credit repair person or you employ an attorney. There are some tax ramifications to this that are difficult to navigate, and you really do need the professional help if you're going to settle and try to get it to report as a paid in full. Okay, I'm going to skip over this one and let's just go to this. Disputing information. Some of you may have heard this. If I dispute information and the creditor does not respond within 30 days, it comes off my credit report. Is that true or is that false? What kind of responses are we getting there, Alina?
We're getting few truths, but mostly false.
A few truths, but mostly false. Well, here's the thing. This is actually true. If I dispute something on my credit report, when that dispute gets to the creditor, they have 30 days to respond. And if it doesn't respond, then it comes off my credit report. So it's true. And then it could become false. And here's what I mean by that. Let's see if I can get to this. So basically, the law, the FACTA Act, Fair and Accurate Credit Transactions Act, says that if the lender doesn't respond within 30 days, it comes off your credit. By the way, this is something from Experian's credit advice site. Pretty good site. I recommend it highly, along with the MyFICO site, as places to go get accurate credit information. But the fact of the matter is that the law recognizes that it may take more than 30 days for a collection agency to get back in touch with the original lender and try to dig out the paperwork that demonstrates that you in fact were the person that took out the loan that went into default. Okay, so they have 30 days to dispute, to process it. If they don't get back to the credit agency with an answer, then it comes off your credit report. But then if 30 or 60 days after that, they find the piece of paper that's got your signature and your date of birth and the security camera footage at the Best Buy store that shows you signing the credit application, they come up with all that, they present it to the credit reporting agency, who says, yes, that was in fact this person. It goes back on your credit report. So it can be a little bit like trick birthday candles. There are people out there who will dispute. There are even companies that will do it on your behalf. But remember that may not stick. You may see it vanish from your credit report only to find it return a couple of months later. So be very careful. Let's talk a little bit more about disputes, if you will. So the Fair and Accurate Credit Transactions Act also has a provision. It was modified, I believe, in 2010, that has a provision that says this. When you dispute something on your credit report, prior to 2010, it went like this. Something showed up on my credit report that belonged to someone else. There just so happens, it's a true story, there is another Robert Fenester who lives in Pittsburgh, Pennsylvania, and sometime in the late 1990s, he declared bankruptcy. Well, the name similarity, and at the time I lived in Pennsylvania, caused some of his credit information to show up on my report. Lowered my credit score. So I disputed it. They researched it. While it was being researched, my credit score stayed down at 650 or wherever it was. And then once they agreed with me that in fact those things did not belong to me, only then did my credit score rise. I was effectively guilty until proven innocent. So the law was amended to say when you dispute something on your credit report, now that account during the dispute no longer factors into the calculation of your credit score. What that does is it effectively invalidates your credit score. You dispute derogatory accounts, you can artificially increase your score. Fannie Mae now requires that all disputes be settled or canceled before you can be finally approved for the mortgage. So think about that. When you dispute something, because of the way the law is now written, you effectively invalidate your credit score. So may not be an easy pill to swallow, but the advice here is, instead of waiting till the last minute and then having to wait, look at your credit report months in advance of your plan to buy a home so that you can get any disputes, get any inaccuracies on your credit report resolved so that we don't have to tell you to stop that dispute. There's a question.
Does the clock restart on disputes, like if you dispute it a second time?
Yes. The question is, if you dispute a second time, does the clock restart? Actually, no, I take it back. The answer to that is no. Generally speaking, you are not allowed to dispute a second time. If you do dispute a second time, if hey, new information came to light that wasn't considered, you can submit that. But you're not going to get the same, lift in your credit score. You're essentially at that point, you've been adjudicated. You're going to be guilty until proven innocent under that circumstance. So be very careful. Make sure when you do dispute, that you provide all the necessary documentation. You've got a winner because it's very difficult to get a second dispute even considered. All right. So the last thing, credit inquiries hurt my credit score. What kind of answers are we getting there, Alina? So if someone inquires, pulls my credit, does that inquiry hurt my credit score?
Of course it does.
All right. So that's what most people believe. That, in fact, is not true. So just think about this for a moment. We're going to go out to, this is the Fair Isaac Company, and see if I can find this. Just find my, okay. So most credit scores, if you can see me here, are not affected by multiple inquiries from auto, mortgage, or student loan lenders within a short period of time. Here's the logic. The credit scoring model wants you to be able to shop for a mortgage. It's an important, it's an important loan you're taking out. They want you to be able to shop for a car loan. It's important. They want you to be able to shop for a student loan. It's important. So the credit scoring model does not lower your credit score when mortgage, auto loan, or student loan lenders run your credit. Now, it is true that if a credit card lender runs your score, the scoring model sees multiple inquiries from credit card lenders as a risk factor, and that can lower your score, okay? But it is not the case for mortgages. And look, I will tell you this, this myth exists, it's widely believed. And yes, it is actually propagated by people in my industry. They don't want you to shop for a mortgage. So they're happy to have you believe that someone else running your credit will lower your score. You won't shop around. It's not true. You can shop around for a mortgage. Mortgage credit inquiries do not hurt your score. One of the reasons why, I keep this for last, why I feel like this is the most important myth to dispel is this. We've just gone through quite a few things here. Don't settle on collection accounts. Don't pay off those collection accounts if you don't have the money to do it. And if you don't use your down payment money on paying off collection accounts. All the missteps that you can take if you don't let some professional look at your credit score. This myth just leads you into those missteps because you don't let someone run your credit. The fact of the matter is a professional mortgage loan officer like myself or any good professional mortgage loan officer can do a lot to help raise your credit score, can advise you to keep you out of trouble so that your mortgage application gets approved ultimately, so that you don't take the missteps that lower your score. So do not buy into this myth. Let a professional see your credit. Get the advice that you need to raise your score. Get approved for the mortgage. Get the best possible interest rate. And that's it. I hope this has been helpful to everyone. And we'll take a few last questions.
I have a question, Bob.
Go ahead.
My question, Tiff, did you have a question? I couldn't see our faces, so I didn't know if you were gearing up.
Yes. So I just wanted to go back to the paying your credit, paying your collections off. Is that it? Would you agree that it's a case by case basis because of what situation, what their mortgage specifics may be? It may be beneficial for someone getting an FHA loan who has a certain amount of debt and a certain credit score, where it might be beneficial for them to pay certain credit collection accounts off.
No, I don't agree with that. It's actually, it's pretty universal. And I'm going to show you something. Can I have the screen share back for 1 second?
You still have it.
Okay. All right. So I am going to show you this. Okay. This is Credit Expert. If you're not familiar with Credit Expert is essentially the credit scoring model reverse engineered. And what it allows me to do is to model things, to say, if I do this, what will happen to my credit score? Okay. In this particular case, this is someone with a 620 credit score. Excuse me. And this is what happens when they pay off this Cap One Auto account was in collections and they pay it off. And if you look here, you'll see it actually lowers their credit score. So let me just try to show you why that happens. This is what a credit report looks like. And if you look here, every credit report has this. It's called a date of last activity, DLA. And the credit scoring model is reading that date of last activity. Now, this happens to be my credit report, and there aren't any collection accounts on it, thankfully. But the credit scoring model sees the date of last activity. That's the date the account went to collections. And what happens is the older a collection account gets, the less impact it's having on your credit score. Now, the credit scoring model is pretty smart, but at the same time, it's pretty dumb in some ways. So here's what happens. And notice that this particular example is Experian, or pardon me, Equifax, is Equifax. So with Equifax, there's a flaw in the model. So when you pay off a collection account, you know, if it's TransUnion, you pay the collection account off, the balance just changes to zero. Mm-hmm. This date of last activity, let me see if I can get the guide back up. This data DLA right here, this date of last activity does not change. But with Equifax, it does. So the scoring model reads a collection account with a date of last activity of yesterday. And the model doesn't know that that activity was you paying it off. It reads it like it just went to collections yesterday. And as a result, it does this to your credit score. I mean, that's a 33-point drop in this person's credit score. So no, it you know, paying off collection accounts, I'm going to end the screen share, does not help. The only time that you would do it would be if, you know, you need to get an FHA loan and you have non-medical collections that exceed $2,000. And then we do it very carefully. And by that, I mean, we get the payoffs for those things and we bring the payoff to the settlement table and we pay it off at closing. But if they pay it off in advance of closing, it could potentially lower their credit score. Okay. So I would never have anyone pay collection accounts off ahead of a closing because of the potential damage it can do to their credit score. You know, the same thing goes for those first-time homebuyer plans. If you're in one and you have to pay them off, you have to do it carefully. You've got to do it at the settlement table so that you go to settlement with your higher credit score. We'll pay them off at the table and just know that your score will potentially drop right after closing as a result. But for the most part, you don't have to pay them. Medical collections, you never have to pay. You know, sometimes you do want to pay them and invoke that New York Attorney General's rule and not just pay them, but make them vanish like they never even happened. And that can give you, a 30, 40-point lift in your score. So does that answer the question?
Yes.
Okay. All right.
When people, you did say, Bob, and I just always like to hear, because people do get scared when they're ready to purchase a home, and let's say they're working with a lender, and just to debunk the fact that their credit will get hit if they, as long as it's mortgage to mortgage. And I always tell people, don't go try to tap for a car, furniture, and all of that stuff. Just if you're trying to find that better rate, a better rate, or whatever you need to do, it's okay to do that.
Yeah. So when it comes to inquiries, and again, they don't, with the exception of credit cards, they typically are not lowering your credit score.
Okay.
And people get hung up on some of the verbiage of this. They'll ask, is it going to be a hard inquiry? And the answer is yes, it is. If you go to a car lender, if you apply for a car loan, it's a hard inquiry. It's not lowering your credit score, but the word hard makes them think like it's doing something bad to their credit. A hard inquiry means this. Now, when I check my own credit, whether it's Credit Karma, the Experian app, all the places I can check it, that's a soft inquiry. I'm looking at my credit, but no one else can see that I did it. If you get a credit card offer in the mail, hey, you're pre-approved for this credit card. Somebody ran your credit. That was a soft inquiry. No one else can see it. You did not initiate it. However, if you apply for a car loan, you initiate it, that's a hard inquiry. And all it means is other lenders can see it. And I need to see it because I need to calculate something called a debt to income ratio. That is, what percentage of your income are you spending on the mortgage payment and all your other monthly payments? So if you just took out a car loan, I need to know what that payment is. So I need to see that inquiry. Okay, there's the inquiry, and it's 2 months before the loan actually appears on your credit score. We need to find out about it in between. So the hard inquiry is to help other lenders calculate those debt to income ratios. It does not mean that your credit score is being lowered.
Okay. Last question, I guess, because I know Tiff has an appointment after this, but I wanted to know, when it comes to, you promote Credit Karma as being a good gauge to be able to have. What do you think about should everyone still pull their annual credit report as well? Should they do that?
It's not as necessary. Credit Karma, while the credit score that it generates is not an official credit score, the data that's there, the actual credit report that you see, is the same credit report. So my credit cards, my mortgage, my car loan, all that information that's there is accurate. So it's an accurate credit report. It's just applying a different mathematical formula to that data to generate the score. So the score is not valid, but it's the exact same report that I see. Same thing goes for the Experian app, which I also have on my phone, Credit Sesame. Most of these free credit reporting places, the scores are not accurate, but the underlying credit report is. So there's really no need. I mean, it's still out there, annualcreditreport.com, but it's just not as useful as it used to be. There are too many other outlets. Doesn't hurt, you can do it, but you've got, frankly, easier places. Credit Karma is a breeze to get through and see your report. Annual credit report, not so much.
So with Credit Karma, would you say the difference between a credit score on Credit Karma and a credit score that you're seeing, what do you estimate the difference in points as?
Once upon a time, it was pretty uniformly about 20-point difference, between 10 and 30 points, 20 points average, and our score would usually be lower. When FICO came out with Model 8, Vantage came out with a new model as well. And what I have found is in the last maybe 18 months, there's been a larger disparity between the two scoring models. I actually had one. I think this was a timing issue, but I actually had a guy show me his Credit Karma. It was 100 points different. Yeah, but I think that had to do with, I was showing what credit score I a
And
report
of course,
I had run about a week and a half earlier. And some payments had posted in the meantime. But that was shocking. And I am seeing some larger differences.
Okay.
I think it's still valid for trend. And I'm going to try to show you this real quickly. I'm going to, if you can indulge me, I'm going to go into my Credit Karma app here. Oh, my daughter just ran her score on Credit Karma. 701. And she just turned 20.
All
Good for her.
right.
Good for her. So if you look here, and I loaded up, this score was actually, there it is, it's 719. And, you
Gotta
really
put it
can't
closer,
see
Bob.
that. So,
Yep, I see it.
all right, here we go. I'm going to move it close.
Yep.
That's actually a graph that shows the trend of what's happening with my credit score.
Pull it back, Bob, and then we'll be able to hear what you said.
Okay, so
Is it-
that's actually that's a graph
Okay.
that shows what has happened with your credit score over recent months. So that's really valuable to just see how your credit score is trending. Okay, and Credit Karma is good for that. There is a place here. It's not so easy to get to. There's a place here where it actually can give you credit advice. That credit expert model that I showed you, they have a version of that on Credit Karma. It's not quite as robust, but you can model your score. If I pay down a credit card, if I open a new credit card, if I pay off my car loan, what happens to my credit score? It will tell you, and it's pretty good. It's not the exact same credit scoring model, but generally it behaves the same. So the advice it gives you is pretty sound for your official score.
Okay.
So it's a good service. The credit score is wrong, but it's a good service.
Well, all good information. Tiff, do you have any other questions?
not in regards to mortgage and credit. I think that was wonderful information for us and our audience.
All right.
Wow.
Thanks, everyone.
How do we find you and where do we find you?
Oh my gosh, I should have a pop-up here. You can find me.
Yes.
Actually, you know what? The easy thing to do is if you Google loan officer extraordinaire, I will pop up.
Yes.
I'm at Green Tree Mortgage. She's holding it up. It's the phone number is 856-341-6636. My name is Bob Fensterer. Easy to find. Google loan officer extraordinaire. There I am. And you will get all my contact information on my company website and through Facebook.
Yes.
Okay.
I didn't have
Because
that.
that's what I was about to ask you. What about your social media handle if somebody were to find you?
It's loan officer
on
extraordinaire.
Facebook?
Loan officer extraordinaire.
Yes.
Okay, so if you Google loan officer extraordinaire, I come up.
Awesome.
I'm Bob Fenster. I usually just use my name. My Instagram is just my name. I do use my personal Facebook a great deal for getting advice out as well.
Okay, great.
Great. Well, we have a couple of announcements before we shoot off, Tiff. Just to talk about what we have coming up. Like we mentioned before, it is Homeownership Month.
Yep.
June is Homeownership Month. And we would like to thank Bob for doing our second session on our myths, credit mortgage myths.
Thank
Bob,
you, Bob.
Thanks
thank
for
you,
having me.
Bob. And we will be on, Lord's willing, next Tuesday as well at 7 o'clock. And we will be talking about D-Free, Get Your House in Order. It's a 12-step savings and budgeting program to help those. I know as we're coming out of COVID or moving through COVID and getting through everything, a lot of people are trying to refocus what their budget is, what their finances are. So we will be on at 7 o'clock next week, which is Tuesday, June the 16th. So we invite everybody to come on, join, tell a friend. You can watch it on replay. We are going to try to load it up to our Facebook, our YouTube, same buy, sell, rent with TNT. So that's all that I have. You can catch us on all type of social media. We're on Instagram, buy, sell, rent with TNT. Tammy T, my realtor, SJ, NARAB, Buy, Sell, Rent with TNT on Facebook. And as a real estate dream finder, we're everywhere in the atmosphere. So, and if you,
Tam, I think there's one thing that we forgot, the myths about working with a realtor.
that is
We
right.
can't escape this session without talking about, what are some of the myths out there, because, I definitely hear people saying, well, I don't really have money to pay you to represent for buyers. They're like, well, I don't know how much it costs for me to have a real estate agent. So let's just put it out there. It doesn't cost a thing.
It doesn't cost a thing.
It doesn't cost
Give
a
us a
thing.
call.
Okay.
Exactly. So give us a call if you're out there and you're looking for a rental, or you're out there and you're looking to buy something. It doesn't cost you. We negotiate with the seller's agent. We cooperate with the seller's agent and getting paid to complete the transaction. But it does not cost the buyer anything to be represented by a real estate agent. The other thing that I wanted to put out there is, when you go to these open houses, buyers, I'm speaking to you directly, buyers, I'm looking at you. So when you go to these open houses, the agent that's there is 9 times out of 10 the seller's agent. It may be somebody else in that office, but the person who is there is 9 times out of 10 the seller's agents, which means they represent the seller, not the buyer. Can you work with a seller's agent? Absolutely. But would you want somebody that's going to represent your interest as well? And not have a conflict of interest? You could be represented by both the buyer's agent, the listing agent. Sorry about that. The listing agent it's possible for them to represent the seller and the buyer. But know, when you walk through those doors and you're going into an open house, that agent is there to represent the seller and that property. They are not your agent. However, they do owe you honesty, and they do owe you information. So if you ask information about the property, they are required to give it to you. So I wanted to dispel any of those myths that are out there that, oh, once you go in and they start talking to you, they're automatically your agent. Nobody's automatically anybody's agent. Tammy, do you have any myths out there that you want to dispel?
I'll have one other myth that I'll just throw out there, and this bounces almost back to Bob when we think about what people need. And this will be on another session, probably in July, but on your down payment. You don't need, a lot of people are scared that they need the 10, 15, 20% down, where you could get there's down payment assistance programs. There's assistance that's out there through your county, through your state programs. Now, there's some stipulations that come with it and going through those programs, but do not feel that you have the inability to purchase a home because you don't have 15, 20, 20%. There are some loan programs that are out there that can accommodate for many circumstances. I know Bob can speak to a couple. I know we won't, like I said, that's another webinar or another session to talk about. But Bob, wouldn't you say that that was true, that people can go into purchasing homes, not necessarily, they used to think 20%, if I don't have 20% down, that I can't purchase a home?
Now there are zero down programs. There are 3% down programs, 3.5% down programs. So yeah, I mean that's and like you said, there are county and state first-time homebuyer assistance plans as well. So there's lots of resources out there, and then start the conversation. If you have the desire to buy a home and you're feeling challenged by the saving for a down payment, call us, and we can give you some options.
I know we could go on because we're in our wheelhouse for a lot of things, but I found one program that was for geared towards veterans, those that were either veterans active or the National Guard. Today I was on a webinar with a down payment assistance program, and they brought up a military down payment assistance program, and I believe it's called, the site is called, I'm looking for it, I had it pulled up, and I think it's PIN. I'm gonna find it and I'll leave you all with that, because it does have a matching program. It's called penfedfoundation.org, and they have a dream maker home buying assistance, and it's for active for veterans, and it's also for those that are in the National Guard as well. So that was a program that I was told about today that could definitely be something that could be helpful to someone. So we're all here for resources that you may need. I appreciate you all's time tonight. Everybody stay safe.
Yes, thank you.
Thanks, Tammy. Thanks, everyone. Good night.
I appreciate it. Thank you. Good night.